They enter here every time, and that is why their trades end up looking like this. In this video, you are going to learn how they analyze the market to get these type of setups. It's going to be a long and complex video to watch, so let's get started. First, let's nail the time frames we're going to use, because I often see traders not properly understanding the importance of time frames and what role they play. First, when you just get into the desk and enter the charts, you must know two very important things: what the market was doing recently and where the market has a higher probability of heading towards. On the first one, we just analyze the swing levels the market was forming in a high time frame. This high time frame is usually the 4-hour chart or the daily chart. Some might say the daily chart is too far away, but I heavily disagree. The daily is the most general chart that we should always keep some form of analysis. From the daily, we can easily transition into both, a lower time frame, but also a higher time frame as well. For example, this is the Nasdaq on the daily chart, and by analyzing the swing levels, we need to know that we started from an uptrend, then formed what it looks to be a maximum high, from where the market started falling down into what it looks to be a downtrend. So the first important things, we checked it. We went from an uptrend into a downtrend. Now into the second important thing. Where is the market likely to be heading to? Here we have two cases depending on what type of trader you are. You can trade with the trend, or you can trade against the trend. Trading with the trend overall should be the best choice for most traders. This will allow you to have a great quality setup. So setups that usually respect, while also setups that give a pretty high risk-reward ratio. And counter-trend traders usually look for setups that are rarely found. It takes a lot of time to find this type of setup. They aim to spot the exact time of reversal. They usually lose a lot of trades before hitting one with a high risk-reward in hopes that few wins will recover a lot of losses. This is harder to do properly, so we usually should stick with the first approach most of the times. That is to follow the trend. And if you remember what I said at the beginning, this market was following an uptrend, up until the price fails to continue higher and prints lower lows with lower highs afterwards, this obviously being a market structure of a downtrend, which is the price action that we have on the last movement. So we have a bearish price action right now. That means the market is in a downtrend. A downtrend has a push and a pullback. The push is to the downside. Its point is to form a lower low. This push also leaves an imbalance in form of a supply or a resistance, which should be the whole last up candle right before the moment the market started to push to the downside. And this zone from top to bottom, the entire zone is the supply. The supply plays a huge role when market enters into a pullback phase, because it's there where it usually goes into, usually marking the top of the pullback before the market enters into another phase of a push to the downside. The target of the new downside movement is to break below the previous low, so it can form a lower low just like it did before. This is what bearish trend continuation is, and we mark that with a break of structure. And after the break of structure, the market should often start a new pullback phase to the upside. Now, if we're looking for trend continuation, we wait for the market to first print a clear price action and entry structures that are aligned with the trend. In this case, we have a downtrend. On downtrends, we sell from supply levels, and we avoid buying from demand levels until the market reverses into an uptrend. So until the reversal happens, we have no reason to be bullish, so we just look for sell setups. At some point, the market will eventually reverse to the upside. That is seen when the pullback breaks above the past high, forming the first higher high. This is the moment we stop looking for sells, and usually after this happens, the market will often retrace back down, but higher than the last low. So in other words, this downside movement is likely to end in a higher low. To know with approximation where this downside movement will end and continue to bounce to the upside, we identify demand levels, and it's from a demand where we will now look for buy setups, targeting the last highs with the take profit. Now we wait and see what happens. We react only when the market gives the opportunity and is more clear in which direction it wants to go. So on the continuation of the price action, we had a small pullback to the upside. This filled a quite small supply from where the market pushed down from that supply, broke the past low, so it continued the downtrend. But then, on the next pullback, we have this chain of bullish candles. A lot of candles closing bullish one after another. This movement breaking above the past high. When the market was previously following a downtrend and it then forms a higher high, the first higher high is now called a market structure shift, or trend shift, or change of character. They're all the same thing. It's important to draw these breaks because it makes noticing the trend and behavior of the market much easier than just not drawing them. So after the trend change from a downtrend into an uptrend, we no longer identify supply zones. Now we are looking for demand zones. Now opposite from the supply, the demand is the last candle that closed bearish that is situated on the lows, and it's the bearish candle that caused the push to the downside. And exactly right after that certain bearish candle, the market started gaining bullish pressure, and that is the demand from the daily chart. Now we need to wait for a pullback, because after a bullish break of structure, or in this case after a bullish trend shift, the market usually pulls back down to fill a demand that we already identified. It eventually pushed back down, and the market is sitting right now inside the demand from the daily time frame. And now we get into the next big part, because we can position a buy setup from this demand, of course, but it will take a lot of time until the setup closes. So what we can use are a few concepts, such as refinement and time frame alignment. These concepts are used when the market fills the high time frame demand. When this happens, what we do next is lowering down time frames. It doesn't matter which one, it just needs to be lower than the one we're currently in. For example, we're now inside the 15 minutes chart, and this is the last move that we can see. Looks to be an uptrend, but for a more clear analysis, we want to zoom out properly and analyze from the very beginning, when the price was outside the demand and what happened when it got into the demand. We look at the swing highs because they look to be forming lower highs multiple times, even on the last high, and lows that are constantly breaking down. Notice how every time the market broke the past lows and we mark the break of structure, after each break of structure we had pullbacks to the upside, these pullbacks eventually pushing back down into breaking the past lows once again. Remember this because we also have a pullback to the upside on the last movements, and as I said on the highs, almost every time the new high failed to break above the last high. The only exception was this one, where it didn't even held and rejected back down. That's why it's very important for the break to happen with a candle closure, else the break is not really of high quality. So now that it's more clear we had a downtrend structure of lows breaking down and highs being lower than past highs, we can move into the last price action, on the last move, and here we have two possible outcomes, a break of the low or a break of the high. If the market breaks above the high, this forms the trend change from a downtrend into an uptrend in this 15 minutes chart. From an uptrend, we look for a pullback to the downside, where we will look for a potential buying setup to take profits above the highs. And this is the scenario that should eventually happen. We just don't know when, because this 15 minutes price is sitting on a demand from the daily chart, so eventually the market has a higher probability of turning to the upside. This is what is called time frame alignment of demand zones. So we only look for buy positions if that happens, else if the other scenario plays out and the market breaks down the past low, this just continues the downtrend on this 15 minutes chart, and we do nothing in that case. Some might look to sell down from a supply since this is downtrend continuation, but the problem these traders don't take into consideration is that we're right now sitting on a demand from the high time frame, and there is higher probability of getting stopped out to the upside. So a smart decision would be just to wait for the market to eventually break the past high, entering into the scenario that I showed earlier, where we form the higher high, shifting the downtrend into an uptrend on this 15 minutes chart, and it's then when we look for another demand, but inside this time frame, and it's from there where we can look for a potential buy setup. So we wait until one of these scenarios play out. Right now we're going slightly higher and consolidating above, followed with a slow bullish momentum. And eventually, we get a bigger push to the upside, breaking the swing high. So we confirmed the trend shift in this 15 minutes chart. The 15 minutes time frame is aligned with the daily time frame, both being in an uptrend, and we're leaving the demand from the daily chart. Now, what we want to do is to zoom inside the last movements, right on this price range. And here we want to look for another demand. So if we analyze how this internal price action was moving, it's basically another type of downtrend that later breaks the last high, forming an internal trend shift. This validates a demand on this range, and the demand, as I said multiple times, is the last bearish candle right before the market started gaining bullish pressure. And this is the internal demand, or the demand from the 15 minutes time frame, and it's from here where we can plan a buy setup, hoping for a pullback into the demand, stop loss below the demand, and take profit above the swing highs. In such a way to target around 2.5 ratio, up to 3, these targets have both consistency and setup quality. When you go above 3, the risk increases by a lot, and those setups are a lot harder to find. And when you go below 2 or 2.5, we might not get as much as we can from a setup. In other words, we shouldn't cut wins so quick. We pulled back into the demand, opening the buy position from where we bounced to the upside. As long as the bullish momentum keeps holding, we're fine. As it did later, closing with the take profit, we're getting a super clean setup after all that analysis. Now after any trade closes, you want to stop for a while and have patience. Do not force trades, because it's far easier and quicker to lose a trade caused by being impatient or greedy. So what we can do is switch back into the daily chart and come back and answer the two questions we asked at the beginning of the video. We need to know what the market has done and where it's probably heading towards. We make a quick summary of what the market has done up until the last price action. So we initially had a downtrend. This downtrend shifted into an uptrend when the market broke above the last high. This left a demand from this daily time frame. This demand later got filled with the market pulling back down. We capitalized from the market bouncing up from the high time frame demand with a buy position, and now we're in the continuation of the bounce. Here we have two scenarios. In one scenario, the uptrend holds continuation with a break of structure. On the other scenario, we get a market structure shift, the uptrend reversing into a downtrend. If we get a break of structure above the last high, we wait the market to pull back down, moment where we should identify a demand on this time frame, and pretty much do the same as we did on the last setup. The goal is to take the market higher with a buy position, and if we get a trend shift with the past low breaking down, then we stop looking for demand levels to buy from, and we just wait the market to pull back up, moment where we should identify a supply level that we can follow with a sell setup. We do nothing until one of these scenarios happen, so we just need patience. Eventually, the break happened to the upside, above the last high. So we got a break of structure on the daily chart, basically an uptrend continuation. So the push is to the upside, then the pullback should be to the downside. The pullback usually ends on a demand. So we identify the last demand on this chart. Should be around here. This is a demand from the daily time frame. The market pulled back right on the top of the demand. Now we do the same thing we did a few minutes ago. We switch into a lower time frame the moment the market fills the main demand from the high time frame. This is on the 15 minutes chart right when the market entered into the daily demand, and what we have is an initial uptrend that later reversed into a downtrend. Each swing high is lower than last one, and each swing low breaks the previous low. So until we have a break of the past high, the expected price action is to form a lower low just like it did before, marking a break of structure. Now after a break of structure, we wait for a pullback to the upside. If that pullback breaks above the last high, we get a market structure shift, so the market is reversing into an uptrend. Until we see a break of the high, we don't take any action on buying or selling. We keep dropping, and here it actually pulled back to the upside and broke back down, so it validates a new break of the low, a new break of structure to the downside. Now again, this validates the new swing lower high, which if it breaks to the upside, we would have a trend shift into an uptrend. And we keep doing this until we eventually get a break of the high. But of course, this upside break needs to happen inside the high time frame demand from the daily chart. Now finally we did break out of the bearish structure by forming a higher high and validating the trend shift. Now we can identify a demand on this time frame, or there is also the option to shift into a lower time frame once again, but not too far away from this one. This doesn't impact the step-by-step process because we still need to identify a demand, so we analyze what just happened, coming from a leg to the upside that followed later with a pull to the downside and continuation of the uptrend by breaking the high. On uptrends, we look for demand zones. The demand should be the last bearish candle before the market started the bullish impulse, around this candle. And it's here where we look for a buy-long position, the stop loss below the demand. The take profit above the recent high. This gives a good enough ratio, around 2.7. I don't like how it's consolidating above the high. Now it's starting the pullback. However, didn't went low enough to fill the demand. It looks like the demand was the other candle, the one from the left this time. But no problem because this is the reality. You're going to miss trades and you're also going to lose trades. What's important is to actually get just a few wins with good risk reward, and that's enough for many missed setups and also for lost setups. When missing a setup, we can just move on with the analysis and look for another opportunity. In this case, it bounced to the upside, and the important part is that the market broke above the past high once again, marking a bullish break of structure. And after a break of structure, we wait for a pullback. Pullback that did happen right here, from where the market is bouncing to the upside. The demand is the candle before the upside impulse. This being a smaller demand, so the targets will be tight. So we try with a buy position on the demand. The stop loss below the low of the demand. Take profit at around 2.5 risk reward. We're starting to go higher. Then it drops down, filling the demand which opens the position. We're bouncing back up, and after a few minutes it hits the take profit target. And that's how they analyze the market to get these high accuracy setups. Now, the concepts used here are explained step by step in my program, so you can start the right way from the very beginning into these more advanced concepts. If you find it useful, you can check it out on the description of this video, and see you on the next one.